Let's connect with Anup Maheshwari, Head of Equities and Corporate Strategy with DSPBR Investment Managers. Anup, morning and fantastic to have you back. Anup, barring some hiccups, maybe one bad day, a bad week, the trajectory of the market has been quite strong. Do you think worst of the price action and worst of the macro action is behind us?
Yeah, I would think the worst of the macro action seems to definitely be behind us. All the issues that we were struggling with last year, this year. Last year it was about the fiscal deficit, this year about the current account deficit and GDP growth slowing down. I think we've seen, pretty much the worst of most of them behind us. So from a macro point of view, I would tend to think, we're at a trough in some ways. I don't think anyone's really anticipating a dramatic improvement in the near term, but at least you're troughing out. So incrementally it's not getting any worse. That's very important. More importantly, from a micro standpoint, if we look at corporates, this quarter has been a little better than what most people were anticipating. And again, while there's no dramatic shift yet, but it does look like at least we've reached some sort of a base as far as earnings is concerned. Also, like you suggested, I think we're just quite enthused by the fact that the market has become a little more broad-based in participation in terms of the nature of businesses that are getting slightly better valuation, and that also normally tends to be a slightly better sign.
Anup, hi, morning. The rupee is already hit 63 again this morning, and the Fed only seems to be getting hawkish with every talk on taper. Do you not see these 2 points as possible deterrents to our markets?
Yeah, it could be. Clearly, I mean, right now flows also are, our markets are so sensitive to global flows that you will keep getting, these sort of volatile movements in the market based on various announcements. So, not for a moment are we saying this is going to be a very nice, smooth market to deal with. But generally, the way we see things is in the middle of all of this volatility, we're looking at some degree of direction eventually coming through, and if we had to take a view, it would be slightly more optimistic than negative. But clearly this still is a market where you need to use the volatility to your advantage. I think it is still in some sense in a trading range. It's just that the range seems to be hopefully heading a little higher, but this is clearly not a runaway market yet. One of the key catalysts we're looking for to get more confident of a good sustainable rally, because that's always what we're finally interested in. That's what gets retail investors interested in the market, when they see some sustainable price performance. And for that, the key variable we've got our eye on is interest rates in the system. So it's only when interest rates are stable or declining that equity markets have the ability to perform in a more sustainable fashion. So that's the one sort of macro variable we'd like to see come through. As far as the currency is concerned, I think we are, just given the nature of global flows and our current account deficit, I think we're going with the assumption that there will be a gradual depreciation every year.
Anup, if I look at your portfolios, Bharti is right at the top there. Bharti, in fact, is your top holding across all portfolios. Why are you bullish on telecom per se?
So Nikunj, when we look at sectors and try and decide whether we want to be overweight or underweight or bullish or negative on a sector, we tend to ask ourselves one moot point, which is there pricing power available in the sector? Clearly, as far as telecom is concerned, we started seeing that pricing power evidencing itself for the last 6 months at least, where they've withdrawn discounts to users, and the fact that the industry has consolidated somewhat thanks to the whole shakeout that occurred is also helping the pricing environment to some extent. So our view was, wherever there is a degree of pricing power, those businesses do tend to generally perform better. I think we've seen the worst of earnings for the sector over the last 3-4 years, and we're expecting an improvement over the next couple of years. The one, I guess, caveat is we've got to see what the spectrum auctions look like, because there's a fair amount of capex that goes in there. But our sense is this market is now, the telecom market is a lot more rational in its pricing, and that should show through in the valuations eventually.
So what's the sense, Anup, that you're getting? Do you think the tilt of the market is going to continue to remain with the defensive names? Pharma, FMCG, IT will continue to look good, or do you think it's now time for some sectoral rotation?
Well, we're already seeing, as I said, the good thing about this market in the last few months is it's become a little more broad-based. So it's clearly not just consumer and pharma. We've seen a fair amount of interest coming in a lot of the sort of value names in the market as well. So, one would argue that this divergence of valuation of the last 3 or 4 years has been fairly stark. We're not expecting massive further divergence from here. So we're looking at some parts of the market hopefully mean reverting as, there's a slight improvement in the whole economic scenario. So the fact that we have a view that the economic scenario seems to have troughed out should logically support some degree of mean reversion in some of the economy sensitive names. And that would come, I guess, at the cost of some of the higher priced businesses that have performed really well over the last 3 or 4 years. So I guess it's the mix that will get more broad-based, and that's the way we're seeing things. And having said that, the defensive businesses, one of the good characteristics about them is, they clearly seem to be a little overpriced today, but they don't tend to, correct dramatically. I mean, they could go through a time correction, but over 5-10 year periods, they do tend to also create value. Whereas the more cyclically oriented part of the market, which has underperformed dramatically, has fairly good scope to come back if there's even a small economic improvement. So overall, we're looking at hopefully the base of this market just getting a bit higher.
Metals and autos then, Anup, are to my mind 2 spaces where perhaps the rotation is already begun. Are there any stocks or names that you like amongst these 2 sectors?
So unfortunately, we can't, as a compliance policy, discuss stocks. We can discuss sectors, and we agree with that view in terms of autos. I think autos is a very interesting space for us, where we're clearly looking to increase our weight over time. I think it's a good combination of being sensitive eventually to interest rates as well as just participating in a very consistent demand growth. And you've got fairly good quality names listed in the auto space, so it sort of matches up on most criteria, and then of course one has to do bottom-up stock picking within that. Metals is a little more of a challenging sector because there are just a lot of global influences, and which part of the metal spectrum you should focus on can produce very different results as well. But metal stocks do have at least the advantage of most of them trading still below book value, and that does give you some valuation comfort. But on metals we typically have a more tactical orientation, whereas in autos it would be more structural.
Right. You also have a decent exposure to private banks, and that's been a constant feature. Are you still a believer of the structural story in private banks, or that's more like mapping up the index and mapping up the benchmark?
No, it's definitely a very strong long-term structural story in private sector banks. I think banks will remain a fairly very important part of this overall market, and within the banks complex, I think private sector banks will over time continue to increase their market share as we've seen over the last decade. So that's the really 40,000 feet view. But the fact is, a lot of the private sector banks now, even if you look at some of the larger names in the place, are not hugely expensive, unlike, let's say, the consumer space. So in that sense, I think the valuations are a little more palatable in the private sector banks. There will be capital raisings that will occur over the next 2 or 3 years, depending on the level of growth that they have, and I think that will continue to support their valuation. So private sector banks, there will be pockets of stress of performance issues if there's a bit of a retail slowdown, but if you look beyond that and you look at the structural story, I think it's still very intact. And over 3-5 year periods, these banks, we think, will continue to compound quite well.
What about consumption? Because that as a theme seems to be tiring out when it comes to the large caps, but off late we are seeing some bounces coming in the likes of Bata, Titan, or for that matter, Jubilant as well.
Sorry, I didn't catch the question very well, but as far as consumption stocks are concerned, it's a bit of a mixed bag, I've got to say. Consumption data hasn't been all that good. If you look at the retail data that's come out, or the same store sales growth for a lot of these names that you may have mentioned, I think it's not really been up to the mark. Now the big question is this a short-term blip, or is it something that is going to last for a while? I guess the next few quarters will let us know. But there is a bit of a blip in consumption. I guess it's largely urban consumption driven at the moment. So I think again you have to be a little more bottom up in this analysis rather than just going with the overriding theme of consumption. I think we clearly have to look at bottom up stories and what sort of growth they're pricing in relative to what's likely to occur.
You don't have a very strong exposure to IT. In fact, you own Wipro. There's very little exposure to any of the key other larger IT stocks. Do you think for IT the springtime is over?
No, as far as IT is concerned, it's again a sector that we like. We'd like to buy it a little cheaper, so we're hoping for some correction there as well. But the fact is, from a business environment perspective, things have improved for them. Corporates abroad do seem to be more inclined to spend. Of course, they're not correlated as strongly to the currency over longer periods of time, but it does accord them some degree of pricing power in the short run. At least the recent currency volatility has helped them acquire more business and they've been able to leverage their margins a little bit for that. So overall, I'd say the IT space is generally in a good place at the moment. There does seem to be some degree of visibility of growth for the next year. You have to look at this, literally year to year. And valuations, at least are not very expensive, so they're more palatable again in the IT sector. So I guess that's a sector that we're quite okay holding on to our positions with. And hopefully, if we get a good correction, then we can maybe add something.
Anup, really good chatting with you. Appreciate you taking the time out and speaking with us.